It's 9 o'clock here, everybody. Welcome to another 1 Million Cups Westminster. I'm Graham Dodge, the Executive Director of the Mid-Atlantic Gigabit Innovation Collaboratory, joined by my fellow organizers from 1 Million Cups. And we are going to just get started because we've got a lot to do today. We have a lot of activity, a lot of presentations and surprises for you today. So I'm going to kick it over to Julia Snap, one of our fellow organizers, to do the overview of 1 Million Cups.
Good morning, everybody. I'm just going to share my screen real quick. All right, so welcome to 1MC Westminster. Our mission here is to lower the barrier for access to education, resources, and connections for entrepreneurs. Without the pillars and the core program, our mission cannot succeed. It cannot be accomplished. Our pillars are, these are presentations, not pitches, and connection, not networking. We really want to get to know your business and the challenges your business faces so we can connect you to the resources we have available in our community. Our culture for the community and by the community, nobody has ownership of 1MC Westminster. Nobody should be paid to do 1MC Westminster. And we are radically and intentionally inclusive. It's really everyone that makes 1MC possible, and we're always looking to find new entrepreneurs and community members. We meet every week, Wednesdays at 9 a.m. We have 2 presenters whenever possible. Presenters' organizations must be less than 5 years old and willing to ask for help, ending with the question, what can we do as a community to help you? Here's our organizing team, and that's it. I'll kick it back over to you, Graham.
Thank you very much, Julius. Also thank you to our sponsors, as always, to Magic, my organization that I'm the executive director of, and then also to Furnace Hills Coffee. Again, if you want to buy any coffee, go to furnacehills.com and you'll get 25% discount by entering the code 1MC Westminster. All right, well, let's go ahead and kick it right on over to Rick Leinbach from Startup Portal with our first presentation this morning. Everybody else, please mute, and we'll do Q&A in the comments afterwards. Rick?
Thanks, Graham. All right. How's that for a screen? Okay. Thanks, everyone. Good morning. Thanks, Graham. My name is Rick Leinbach. I'm the CFO advisor and founder of Startup Portal. Entrepreneur Magazine, like many magazines, had a top 10 mistakes that people make when going out for startups. We at Startup Portal hope to help a startup, avoid at least half of these mistakes. Now, our first pillar is we take you from plan to profit. Our goal is to start you from day one, helping you establish your foundation. And a lot of times that foundation is using, Google Workspace or even free Google, but very inexpensive platform. We actually, outside of startups, want every business to think like a startup. And our goal, especially year one with startups, is to have a fixed fee environment where expectations and we're here to help you and really gaining that trust. And the other element here is that raising capital is not necessary on day one. So really thinking through your plan and looking at what's your next steps without thinking I have to go out and raise money and basically build that business. We want you to be a CFO, we want to be the CFO at your side. Now, our space is here in Westminster, Maryland. Half the space is designed for events, training, etc. That was pre-COVID, of course. The other half, really, we have client services. So it's a storefront. You walk in and we work with you. We're researching, looking at having a shared space for our clients. And we're obviously in 2021 going to ramp up our Zoom presentations and remote planning. Now, the core of Startup Portal is we're your financial arm. We have your plan together where we introduce you, you come in, we do financials, we work through the financials, we put that financial together, but the core is most people aren't accountants, so we train them via metrics. So really helping them, tell their story financially without having to be a CPA. Now, our services, anywhere from governments to helping with receivables, putting together a cap table, evaluating financing options. Now, for us, after we get through that initial plan, the goal is to help gain the confidence and work with you ongoing, have our staff assist you, provide industry experts at our side, referrals, contacts, and really help you grow using cloud-based platforms like QuickBooks. Now, target market, right now the age is we're seeing 25 to 40-year-olds. The real goal with Startup Portal is to expand that range. One of our missions is really, we want people to understand they can leverage their life experiences in what they call the fourth industrial revolution, where things are changing so fast, and using the cloud. Now, audience-wise, individuals, incubators, private equity. My work, consulting-wise, we do work with publicly traded companies as well, so we have the gambit. Educational platforms, one-on-one training, seminars, monthly education. We'll be coming out with our newsletters, monthly newsletter soon. So one thing we encourage is people, as they come to Startup Portal, is they want to write their own business plan. Most people don't, but we encourage it, only because you have to own it when you go to present to, whether it's private equity, to a banker, to grandma. You have to be able to own it. Now, part of our services and pricing, we're looking at how do we provide services on a fixed monthly fee. Our range right now, and I'd love input, is around $250 a month, or a block, let's say, depending on how long it would take that we can estimate. Now, our second pillar, let's say, is really we deliver the financial confidence for anybody putting together a business plan. And we're doing that through helping them tell their story. If I had to pitch this presentation of a 5-year model, and I see first year, I have 1,000 units and I'm losing money, I really want to tell the story of year 5. I want people to get excited on how I get there, because year 5 is really year 5 through 20. And I also want to see that, hey, it's okay to lose money potentially in year 1, you just have to fund it. But by year 5, you're kicking off cash flow. And that's how you get people excited. And that's how we build the confidence. Second piece is we're building the confidence by pulling down data from the Securities and Exchange Commission on a daily basis of actual companies. And we're benchmarking companies so you can see whatever your company is. And I have a brewery here, brewery for 2019 as an example of just what your revenue should be, what your margin should be, what your costs may be. So you have more confidence as you tell your plan. The third pillar, we put you in position to raise capital. We don't raise capital for you, we put you in position, because there's lots of avenues to go do that. Whether it's loans, equity, revenue share. Really, when we're sitting down, I want you to think of your second financing, not just your first. Just for the fact that if you go out and raise money from 1,000 people, but then you go to a private equity group, they're going to say, well, you have 1,000 partners. We just want to work with you. So really think about that second financing. Now, there are types of loans. SBA loans are great. Traditional bank loans are good. And friends and family. And with friends and family, we're now rolling to a new type of funding, equity crowdfunding, which has started in the Jobs Act 2012, where really equity crowdfunding can do equity, revenue share, loans. And revenue share is where you agree to give a certain percentage of your revenue over a period of time, and they start getting the money back right away, which is one of my favorites, by the way. But the traditional aspect of going to a one-on-one relationship now goes to the crowd through funding portals. And Mr. Wonderful is part of one of the funding portals that really is validating the market. So this is evolving. I think it's a little bit like the Wild West right now, but it's evolving, and there's a ton of data out there. For example, to the right, here are some of the things that we're covering on our in our database, but these are the crowdfundings for the last year essentially. And you can see the Start Engine with Mr. Wonderful has had many deals, and it really is evolving. The last element of crowdfunding is that these are the states. Typically California, New York, Texas, really where the deals are, and it's really rolling across the country over the next couple of years. Now, over to the right, you'll see valuations. I am concerned when a restaurant has the same valuation as potential startup a software company. So there are some valuation issues, as I mentioned, about the Wild West, but it's evolving, and hopefully, as time goes on, people will see this as another alternative vehicle of investing. Just got to be careful as you do it. So that is Startup Portal, and I'd love to take any questions.
Excellent work, Rick. Thank you very much.
Sure,
I'm
let me
glad
stop.
to see you successfully transition from attendee to presenter. Thank you very much.
Yes, okay.
So
Lot there in 6 minutes, by the way. Sorry
that
about
was a
that.
lot, yes.
So,
So if anyone has questions for Rick, let's direct them over here to the chat and I'll read through them. I'm curious, I saw SI Securities in there. That's Seed Invest, and I actually raised through Seed Invest successfully.
oh,
What
nice.
else are you seeing that helps, that lends itself to a successful crowdfunding campaign? Because I know a lot of people try it and don't reach their goals.
Yeah, I think from what I've seen, first and foremost, is that a lot of companies are launching and they have this great idea and they think the crowd's just going to come to them. What the model with crowdfunding is really, if you have a strong crowd, if you have people that are going to front you right away to get that boost, you're going to be more successful. And getting people excited to say, hey, wait a second, you're trying to give 50,000, you come out of the chute with 15,000 raised, 20,000 raised, you'll get attention. What I see is people turn then, when they're not there, they turn to Facebook.
Mhm.
And the advertising dollars are significant in Facebook. There could be a 10, 20% investment in Facebook to raise $1 million, which is not true capital in my mind. So I think if you're going to do this, especially on a smaller scale, you have to have a huge database and sell it before it goes.
Right. Yeah, that's good advice. Yeah, I found that getting the word out through, there was a publisher actually in Baltimore called, oh shoot, I'm gonna forget the name now, but they had a mailing list of, hundreds of thousands of high net worth individuals. And if they made a hard recommendation of your crowdfunding campaign, it was sure to get funded and meet its goals. So yeah, it's all about getting those,
right,
getting
and
that audience.
And honestly, if I look back to what I'm trying to do with this, obviously startup portal is really to help individuals and businesses put themselves in position to grow. But the crowdfunding piece is great for benchmarking. And really, as I get out through 2021, I want to say I want to be the Simon Cowell of the crowdfunding, just for the fact that you want people to get a return on their investment. It concerns me that you can put $100 in, but you never get it back.
Yeah.
Because it's just diluted like crazy. And some of the valuations, if I could show my screen, again, I'm going to show this. Some of the valuations that are out there. I got this. If you can see that, I don't need a date right now, but you can see over to the right, let's use this valuation cap. A technology company and a biotech may have an average valuation, and some of this data is a little crude, but have a valuation of 13, 19 million. But you go down to a restaurant and a bar, it's got a $13 million valuation. It's like, that's the education part. I want people to understand that you really, I want to say it's the Wild West a little bit, but you can tell, with the $13 million valuation on a restaurant, you're just not going to get your return on investment. I even saw a brewery with an $84 million valuation.
Wow.
So that's the kind of stuff that, hopefully people, it's a great solution. I really like it. I just am concerned that, it's not a fair exchange. So that's why if you look at RevShare.
Well, I was going to ask you about that, but let me get to a couple of questions
Okay.
here from the group. Tina Thomas from Infinite Love Project asks, how important is it, oops, I lost it. How important is the number of years in business to funding a business for growth? Does that make a difference in terms of how long they've been in business?
I don't think it makes a difference. I mean, I honestly step back. One of my points was every company should think like a startup. Just because you've been in business does not mean you're relevant in 2 years from now, especially as things are changing. People are using the cloud. They're using different softwares. So, and really to raise capital, if you've been in business 5 years and your story's changing, you're going to fund that change. It can be a good story because people have confidence that you can run a business.
Right. Chris College from TCP Venture Capital, who's our next guest today, he asked, what was the monthly pricing for your services again? Was it $250 a month?
Well, I'm trying to work around $250 a month, and I almost want to do a block type scenario where we can map out, say, an entire year, and someone wants to come in and just have their business plan. and pause. I'm not looking for, I'm looking to honestly for what I do to gain trust and services, gain trust and confidence, sorry, excuse me, of someone where, let's say it takes 3 months to do a business plan. So it'd be about $750. And then you can take a pause, go through, come back, and we talk how to get your finance, set up and come to Startup Portal and pitch your financing, et cetera. So,
And that 250, that includes outsourced CFO services like bookkeeping and budgeting?
yeah, that 250, again, a part of the platform, you would eventually get to the monthly bookkeeping.
Okay.
And the 250 would say we do, I do include, because of the cost, the QuickBooks Online is usually included with it on the monthly services.
Gotcha. Chris has a follow-up question here too. What are the restrictions on future capital raises if you take crowdfunding?
Well, honestly, the restriction from the standpoint of your story, like I said, it may preclude you from raising $10 million if you've got 100,000 with 1,000 people. But from the standpoint of regulations with the SEC, you have reporting requirements, but there's no restrictions of going out and achieving like a Reg D offering. Or some people, what I showed you is equity crowdfunding CF, which is under $1 million. It's going to 5 million, but it's under $1 million for last year. You can go up to Reg A from the CF. It's a good trajectory to that. And I have a Reg A client that's probably going to be on the Go Public or OTC next year, just for the fact they have 5,000 shareholders. But there's no legal restriction that I'm aware of, no attorney here, but that would preclude you from getting a private placement on top of that.
And we have a question here from Jennifer Young of Covalent Spirits and a fellow Magic board member. She's asking, what are the pros and cons as compared to reward-based crowdfunding, for example, Kickstarter, GoFundMe, et cetera?
Right. I would say the Kickstarter's GoFundMe is great. It's an even exchange. You have a contribution, you get a t-shirt back, or you get a free service. With equity crowdfunding, if you're looking, two elements here. If you're looking to have a nice, strong base, I bring up breweries, and I love breweries for the fact that typically you want to get the people in your area to be invested in it. And you're going to come back and support your own investment. So that type of benefit is that you almost have like a collective shareholder customer base to do that.
Yeah, excellent. Yeah, I think there is a common misconception also between crowdfunding sites like Kickstarter and then equity crowdfunding
Right.
that's regulated.
Yeah, it truly is. It's a new beast, and you can go to many of these portals and look at these companies and what they're raising, and it's pretty straightforward.
In your presentation, you mentioned revenue financing. Is that, are you referring to like loan factoring, or what is that exactly?
No, I mentioned revenue share.
The revenue.
Basically, yeah, revenue share. Basically, there are agreements where you can do equity crowdfunding, and I like this because you don't have to worry about like giving up a piece of your business. You basically say, hey, if I raise $100,000 over the next period of time, I'm going to give you a return of 140%. So the investor will get a 40% return over a period of time based on revenue, not net profit. So you're getting your money back right away. Now, the downside that I see is some of these deals are like over 8 years. And it's like, if you do the math, you're better off just sticking in the market. But if I have a rev share for two-year period of time and 40% return, the investor wins and the company gets their funding. So that's, so that type of thing is evolving, and hopefully will be more and more prevalent.
It seems like that kind of deal might complicate subsequent funding opportunities with like venture capital.
Yep. Yeah, you got to think
taking the money off the top, right?
Yep, you got to think of your second financing.
Right. Yeah.
You really do.
Any other questions from the group here? While we've got Rick,
Graham, if I may.
Yeah, go ahead.
Hey, Tina.
Go ahead, Tina.
Oh, I just wanted to say that, Infinite Love Project has been working with Rick and his team for a number of months now. And I can honestly say that that he is my CFO, thankfully. We're a small business, and he and his team are helping get the numbers the way they need to be. and so we can look at them in a CFO way to validate, you know, the growth of the company, that it's doing the right things from a monetary business standpoint. He, as CFO, he's asking the right questions and helping steer me to the right things that need to happen. So I can wholeheartedly recommend working with Startup Portal. They're awesome to work with.
Oh, thanks, Tina.
That's
Yeah,
a great testimonial. Thank you.
Yeah, I asked Tina, my question to Tina was, which I saw last year's revenue. I was like, what are you going to do next year? She had an answer, which was nice. So,
Deb Cancro has a question from VoiceVibes. Well, formerly of VoiceVibes, I guess. We'll talk about that in a minute. She says, hey, Rick, sorry I joined halfway into your presentation. Was wondering if you help companies that don't want to do crowdfunding too. And I guess the answer is yes.
oh, absolutely. Yeah, I have clients that are traditional, normal clients that are raising capital through traditional ways, and even have public clients.
Yeah, I mean, essentially, Rick is an outsourced CFO, Startup Portals, that provides that service. And
Right.
it sounds like Rick is flirting with a monthly flat fee for those
Right.
services.
Yeah, absolutely. And part of the consulting work I do is under Carrollton Partners, where I go in and work with anywhere from construction to distribution companies, software companies. I have a software company in New York that I work with that does, you know, so the gambit of outsourced fractional CFO services really is here to stay. And I see it, and I give a lot of credit to Tom Hood at the MACPA, who has educated us as CPAs over the last 5 years about this fourth industrial revolution, the change using the cloud. And that's part of the reason why I'm doing what I'm doing. So really getting ready for the next round.
And, just maybe briefly talk about how you did go from being an accountant, a CPA, to starting a Startup Portal.
Yeah, well, I mean, career-wise, I worked in regional accounting firms. And then I thought back in the 20 years ago, 25 years ago with the bubble, which we may be there now. I was like, oh, I got to work for a public company. So I literally worked for a few years at a company called Snyder Communications in Bethesda, which the owner of the Redskins is Dan Snyder. So he was there. It was crazy, and he bought the team at the time. So it was fun. A lot of experience in a few years. But from there, I went to work as more traditional controller. With Sarbanes-Oxley, went back to be CFO of a public company, and eventually when that company was sold and we moved it to Wisconsin, I was CFO for a year of a company where we went out to raise capital. And the irony in today is that we were refurbishing games for video games. That is called Game Traders Factory, and we're raising capital around the country and did a roadshow. And so many people were saying, "Hey, you're selling products to GameStop." GameStop's the company out there today getting all the talk. You're selling refurbished video games to companies, and you're basically buying it from Toys R Us and Walmart, and then selling it to GameStop, and you're cleaning it up in between. And I'm talking bulk trade. So we need capital. So we went on a road show around the country, spent 3 weeks, in every hotel saw San Diego from the back of a car. And we get on the last day and we're in San Francisco. And this is a lesson learned for everybody. We had a call from the attorney saying, NASDAQ has a problem with you. And basically the company had a call from FINRA once or twice prior to me being there. And nobody knew who FINRA was, so they never called him back. So lo and behold, a week later, we're in front of the NASDAQ listing committee. And the guy sits back and he says, why don't you come back when you grow up? Basically, and we were done. So,
Wow.
So yeah, so for me, I mean, I've got some good stories that, and experiences that I have thoughtfully put through what I'm doing at Startup Portal. And it's really it's to help people as they look forward, and any decision you make today will come back and hurt you 2 years from now if you're not careful.
Well, we also have a quick follow-up from Deb here. Do you ever work for equity if you love the idea?
It's funny. You say that. I have a premise, and it's based on experience and a deal that I've done here in Westminster that with Startup Portal, no equity in the first year. It's about trust and confidence. So I do have companies I get equity and options from, more of the public companies, but equity first year with startup portal, I try to avoid it. Never say never, but it's unlikely that I would work for equity in year one.
Well, thank you very much for your presentation, Rick. Of course, we always add or ask at the end, what can our community, which is your community here in Westminster, what can we do for you?
Yep, it's very simple. For me, as Tina mentioned, even if you can't afford it, come, we can help you. If you want to sit down and just have us benchmark you and look at our services, feedback on, hey, pricing, feedback on, hey, I'm thinking about doing something, but how do I fit? So feel free to reach out and be glad to have a conversation. And the other element is I'm really working on building the benchmarking for financials. So if you confidentially want us to do a side-by-side, we're here for you in Westminster. And my goal is to really make it work here. I'd be glad to do that for you and say, okay, if I'm a restaurant, what are other restaurants doing around the country?
Very cool. That
So,
sounds like a really valuable service.
Yeah,
Right.
that's perfect. I appreciate it. Thank you.
Thank you very much, Rick. So before we get to our fireside chat with our special guest, Christopher College at TCP Venture Capital, I wanted to quickly reintroduce Deb Cancro from VoiceVibes to everybody. And if you've been part of these calls in the past, you will remember her presentation of VoiceVibes here at 1 Million Cups Westminster. And she has since successfully had her company be acquired by a big publicly traded company, I think in Australia, called Big Tin Can. But I'm going to let Deb take it from here and just give you a couple-minute update as to how this transaction happened, as much as she's able and willing to share. So Deb, please, first of all, congratulations.
Thank you.
Huge.
Thank you.
It's
Thanks
huge.
for inviting me back. I'm happy to share the good news. Yeah, we're delighted. We've been talking to this company since October, but I had talked to other companies about acquiring us before, so never got my hopes up. And then I don't know, it finally happened. I'm delighted, and I'm still an employee now of the new company, and I'll continue to do the same thing I'm doing. But overnight, we kind of jumped from being this really seed stage early situation where I have 20 hats to now we're more growth stage, and I can focus and hand off probably 18 of those 20 hats to other people that'll do those jobs much better. And so I'm just delighted.
And I know a lot of the details are public because it is a publicly traded company. Do you want to just share with the audience here who hasn't seen the articles, what that all looked like?
Yeah, I guess it is public. I haven't really shared numbers, but I saw it in an article. The whole valuation was $2 million. And it was a combination of stock and cash, and our investors got a return, and Tedco got their money back with interest. They were one of our first investors early on. So I'm very happy with the outcome personally. I still retained a lot of the equity in the company. So just all around, we're all really happy.
Yeah, no, it's awesome. I mean, again, it's a huge win for everyone involved in VoiceVibes. And, it makes it easier for you as a founder to go off and raise money again, should you have another idea for another company. Have you thought about that? Or, are you just thinking in terms of staying with this and growing this as much as you can with the new parent company?
Yeah, right now I'm very excited to be a team player and to keep growing what was my baby, and being part of a bigger team so this can go faster and scale. So I'm just excited to be a team player for the next few years, and we'll see what happens after that.
Well, you're getting congratulated by Josh Ambrose from Johns Hopkins, Tamar Osterman from Maryland Economic Development. Tina, everyone's congratulating you.
Thank you.
Thank you for sharing that with us today. I think it's good for other entrepreneurs to see these kinds of outcomes, because, when you're in the thick of it, sometimes it's hard to see the forest for the trees, and you got to now see the whole life cycle.
Amen. I mean, this isn't the outcome. When I started the company, I thought we'd sell for 40 million someday and much faster. So, it's really hard. I never thought, I started Autonomy Engine in 2010. I pivoted to this VoiceVibes idea in 2012, and I've been working on it full time since then. So, I mean, I'm very happy with the outcome, but I gotta say, it was way harder than I ever dreamed.
Took twice as long and cost twice as much money as you expected, right?
Yeah, exactly.
Excellent. Well, if anybody has any other questions for Deb, just go ahead and post them in there. But I just wanted to keep it brief, congratulate you, let you have an opportunity to kind of share with the community here what that all looked like, and so they can learn from your experience as well. And I know Deb is very giving of her time, so I'm sure if anybody wants to follow up with you, they can reach out.
Absolutely. I'm
So,
so
and you're
thankful about it.
you're staying in Maryland, right? You're not moving to Australia now?
No, no, they've got a lot of offices in the US, and I'm working from home for the foreseeable future. So that's good. And I keep trying to sell them on what a great place Sykesville is, and Westminster too, but that this is a great place for people to live and work, especially now that everybody's more open to being virtual. I've always been a big proponent of virtual, being a mom and everything, and I feel like society's catching up.
Yeah.
But yeah, so, you know, Silicon Main Street.
Exactly. All right. Well, thank you very much, Deb. I'll take you out of the hot seat here now, and we will kick it over to our next presentation / fireside chat. This is a first in a series that Magic is sponsoring called Investor Talks. And our very first investor is Christopher College of TCP Venture Capital. Let me just make sure I'm doing this correctly. And Russ, you might need to help me make sure we can spotlight Chris and go back to that view for him. But Chris, go ahead and introduce yourself and TCP Venture Capital and take it away.
Terrific. Thank you, Graham. And I'm Chris College with TCP Venture Capital. First off, I'd like to say that watching Rick and going through his presentation, that's a great resource for this area. And I see a lot of intermediaries are providing those types of resources. And at those kind of price points with that kind of service and expertise, people should take advantage of it. And I guess I'd also say, Deb, congratulations. You know, all exits are great exits. That's the hardest thing to do. And very proud of you. So, you know, that's a terrific thing, and we need to celebrate it and celebrate local exits more than anything else. With that, my thought process here, I told Graham this morning, was I'd probably give you a minute on my background, 2 or 3 minutes on our firm and what we do, and then really just turn it over to the audience to be able to ask questions and make this interactive and beneficial for everybody else, so that you can ask that question that you've always wanted to ask a venture capitalist that is usually hard to find one that's willing to sit down and talk about it. So with that, I was an investment banker for 20 years. I worked primarily at Legg Mason and Stifel Nicolaus here in Baltimore for about 13 years, Robert W. Baird in Tampa, Florida for about 5. Did all different types of financings from IPOs to M&A to private placements. And really the last 15 years of my career as investment banker, I was helping early stage companies raise capital in the private and public markets. And for about 7 of those years at Stifel, Nicolaus, and Legg Mason, I ran the private finance department, and our team would go out and raise $5 to $150 million for businesses, usually early stage technology businesses. Was happy doing that, living here actually up in Hampstead, commuting an hour a day. And then I had kids, and kids came into the picture, and I was on a plane 4 or 5 days a week, sometimes every day, every week, and had to try to figure out a different lifestyle to maintain some work-life balance. And what I did for basically 20 years was meet with 400, 500 companies a year and pick 4 or 5 of them to go raise money for them and get paid a placement fee to do that. And we only got paid if we were successful raising money for companies. So I got pretty good over those 20 years of picking companies that could be successful and did have a good business going forward. When I decided to change careers and try to balance that work-life balance, myself and a couple organizations down in Baltimore came up with the first thesis, which was the Propel Baltimore Fund. And in that fund, we got backing by many of the large foundations in Baltimore, corporations like Brown Advisory, T. Rowe Price, the Able Foundation, the France Merrick Foundation, the Chesapeake Bay Foundation. And we started a venture capital fund that would focus primarily on investing in companies that would headquarter in Baltimore City. And most of the organizations that gave us capital cared about Baltimore City and growing jobs and businesses there. So our first fund was really focused on companies that would move to Baltimore City. And that was 9 years ago. And we're now on our third fund, which just made its last investment yesterday in a company called Qualytics. And we'll be on the road raising our fourth fund in the coming months. I'll give you a little bit more background on what we invest in, just so you can have an idea before we open it up for questions. But our firm is usually making $250,000 to $500,000 initial investments. And we usually make about $1.5 million to $2 million over the life of an investment. We try to get into companies that we're investing in. We invest in any kind of technology company, provided it does not need FDA approval. So we don't do biotech or med device. We like to invest very early. We are probably the most active early stage investor in this region. We'll invest before companies even have revenue. We'll invest when it's still an idea. We like to invest when there's a product or a service or software that's created and is in a pilot stage, but a lot of times those pilots are unpaid pilots. And I think we think of ourselves as, good corporate and community citizens. So we're always willing to meet with companies and try to help them out, even if they're not going to be a fit for us. And I think with that, maybe I'll stop there and see if there's questions about any of the background or the firm, and then we can open it up, Graham.
Thank you very much. Tamar Osterman is just from Maryland Economic Developments. Thank you for being so accessible and generous with your time and expertise. Deb is also thanking you. I think it's good for some of the entrepreneurs here to maybe also understand the difference between what would be called a lifestyle business versus a fundable business versus maybe even a VC-backed fundable business. Like, how do you sort of delineate between those when you're looking at a startup company?
Sure. In general, if the company needs additional people to scale, like a consulting business or a people business where you have people on a manufacturing line, it's not going to be a venture capital type business. We are looking at, our targets are 3.5 times our money over 5 years. So that means a business really needs to grow their income at a rate of 35% per year, or it's probably a bad decision for them to take our expensive money. So that means, it has to be a business or a concept where you get a lot of leverage. You're usually losing a lot of money for the first 2 or 3 years, like Rick showed in his pro formas. But then in years 4, 5, and 6, you're starting to become wildly profitable because you've covered those kind of fixed overhead costs. And then the revenue that's incremental really falls to the bottom line, and you're able to grow the business very, very quickly over time. I'd say that, all businesses are good business, whether they're lifestyle businesses or slow growth businesses. I would just say that you want to try to match your funding sources to your growth potential. And the reason we look for such high returns is because most of our companies are not going to hit their targets. We're usually going to have, if we make 10 investments, we're going to have 2 of them that we make 5 or 6 or 10 times our money. We're going to have 2 or 3 of them that we lose every penny of our money. And there's going to be 2 or 3 that we're going to double or triple our money. And then there's going to be 2 or 3 where we just get our money back. So the risk return in venture capital is very high versus businesses that are probably less risky can look for capital that's less risky.
Excellent, thank you. Will Wong is asking, how stringent is the based in Baltimore rule, and is there a possibility for investment in other companies in the DMV area?
Sure. So we manage 3 funds right now. 2 of those 3 are from that Propel Baltimore series. The other one is not. And invested in 2 companies, one in Annapolis, and actually one in Philadelphia. In that fund, yes, we do need companies to headquarter in Baltimore post-pandemic. But for good companies, there's lots of investors around this Delmarva area. And we're actually in the process of looking at putting together another fund, which would be our 5th fund, which would be significantly focused just on the Mid-Atlantic. So for the one fund that we do manage, it is a pretty hard, fast rule that's your commitment over time.
And that's the Propel Baltimore Fund, right?
That is Propel Baltimore Fund, correct?
Right, and I know like Able Foundation, for example, that's when you have LPs like them, I imagine that's what defines that sort of investment thesis, right? That fund.
That's correct. So that the
Oh, did we lose him? You froze, Chris. Hopefully he comes back. I think Chris is outside the Westminster's gigabit fiber network, so.
He is. He's in Hampstead, I think.
Yeah. Let's see if he gets back on here.
Maybe you should send him a chat. He may not know.
Yeah, let me just send a quick. It's getting good. Hold on. Froze. All right, looks like he's going to log back in. Yeah, so keep the questions coming for Chris. We have 15 minutes here left, and lots more to get through with him, I'm sure.
Can you hear me now?
Oh, there you are, Chris. Yes, thank you for coming back on.
Sorry about that.
That's all right. So you were just explaining about Propel Baltimore and the investment thesis for Baltimore with the LPs of that fund.
Right. So so because those LPs really did care primarily about Baltimore City, the requirement to headquarter in Baltimore City post pandemic is pretty strict.
Gotcha.
Yeah.
Rick from Startup Portal asks, if an investment is $1 million, what is the typical breakout between funding infrastructure / software, operations, and working capital?
I don't think there's a typical, and I don't think one's better or worse than the others. What we like to think about when we're investing is if you raise $1 million, what are the objectives that you're going to be able to accomplish with it? Are you going to be able to get 5 customers? Are you going to be able to build a new edition of your software? Whatever the milestone that's going to create new value, that's what just has to match up. So the $1 million has to match up with whatever that milestone is and what you're trying to accomplish. We funded marketing completely. We funded software development completely in investments before.
And you mentioned earlier in terms of, one of the things you look for as something that would preclude you from investing would be that if the growth is dependent on number of people, but if it's the sales organization within the company that's expanding and it's a matter of just throwing more salespeople, is that the same thing, or are you talking about something different in terms of the staffing issue?
No, that's increasing sales and throwing money at sales is not a problem. What I was referring to more is if you're running a law firm or an accounting firm or a firm where you're only able to provide more of your services by adding more people and it's a linear function. I can get 5 more customers, but I have to add 2 more accountants to get 5 more customers. And that ratio always stays the same. Those are the type of businesses that probably aren't good for venture capital.
So professional services seem to fall within that category.
Exactly.
Yeah. I also have a question. We mentioned LP, and for those who don't know, LP stands for limited partner. And maybe, Chris, you can maybe just explain real quick, what is that relationship? And is it similar, in terms of how the startups that you invest in, how they have reporting requirements and a relationship with you, that they maintain a certain level of transparency and a certain cadence with. Are you doing the same thing with your LPs? And is that, is there a metaphor there or a similarity?
I think the metaphor, the lesson there is transparency. I will tell you that we are in the business of losing money. We lose money all the time in companies that go out of business. But what I don't want to have happen is we're doing great, and then a month later, we're out of business. We like to know what's going on. If we're going to lose money, we're big boys, and we like to try to be there to help not lose the money and try to solve the problems and figure out what's working and what's not working. So, we don't mind business problems. There's always going to be business problems, but the transparency to know what they are, to help try to fix them, rather than not addressing them or not being transparent about them. That's what is problematic in the relationship between investors and companies. We once had an investment in a very promising company. We were talking about selling the business. It was not a big exit. It was probably going to be a $7 or $8 million exit. There was probably $4 or $5 million into the company, so it wasn't going to be a great return. But in a board meeting at 7 p.m., the board a week before had told that we had 3 months of runway to be able to accomplish the sale. That night, the board started asking questions, and we determined that really we had about 6 days of runway before we couldn't pay the employees. And we ended up shutting the whole business down because the management team wasn't transparent. In that case, it wasn't because they were trying to be misleading. It was because they just didn't know what they didn't know. But they weren't interacting with the board. They weren't talking to their investors often enough.
So, and that sometimes seems like it can come at odds with the CEO's responsibility to sell the biggest vision of the company. So I guess maybe what is your recommendation to entrepreneurs that are starting out, that are having to think of what is the biggest, boldest vision, what is the biggest number that they can aspire to, versus that relationship where that transparency is so key, and making sure that they're not drinking their own Kool-Aid, for example? Like how do entrepreneurs reconcile those two things, I guess, would be a question.
I think you just have to be realistic. Our job, after we talk to so many companies, and if you've got a realistic plan and you have a basis for your ideas or your expectations, that's all we can ask. Nobody has a crystal ball. But if you sit there and you're coming up with a plan that 9 out of 10 people on the street would say is unrealistic, then you've probably lost credibility with your investors, and you're probably not going to get the money. So I think the answer is all entrepreneurs wouldn't be entrepreneurs if they weren't bullish and didn't believe in what they were doing. But you have to temper that with what's based upon some type of facts or some type of buildup, either in the numbers or in the marketplace or in the business plan. And then you work through it with your investors and with your stakeholders.
I think that's excellent advice. That's probably something that a lot of entrepreneurs need to understand, because you get that, they hear so much that fake it till you make it mantra, right? And then I think that gets them used to certain level of dream building. Like I said earlier, like I use the expression drinking their own Kool-Aid. I think that can happen to a lot of entrepreneurs very easily. So it's good for them to see it through the lens of, I think, the investor and the sort of the pragmatism of what that vision then translates to later on. Deb from VoiceVibes is asking, have you given much thought about the personality type of entrepreneurs, and if certain types are, 1, more fundable, or 2, more successful?
Yes, I'd say that we spend the majority of our time trying to figure out if the team is the right team for the type of project, for the type of company. And you want to work with people that are go-getters, that are excited, that have passion, dedication. You also have to be able to trust those people and build confidence in them. So I'd say that we spend more time trying to ascertain what the team we're backing is going to be like after we give them the money than anything else, other than probably does the business plan make sense? And we love people, Deb, like you, that have done it before, that have seen how hard the work is, because it's really hard. It's you need a whole community to build a business. And I'd say that's one of the things that a lot of entrepreneurs underestimate or don't take advantage of, is things like A Million Cups, where you got to reach out and get resources. You can't do it yourself. But I wouldn't say that there's one, typical personality trait. Hard work, confidence, transparency, ability to learn, and also coachable, I guess, are the things that you often hear associated with good CEOs. Some of my favorite CEOs are the ones that will sit there and listen to all 4 angles on the question, and maybe they don't agree with 3 of them, but they explain why they don't agree with it, and they go with the other one. But they've listened to all the points of views, they've got educated, and then they make a good decision. Even if it's the wrong decision, they've gone through the process the right way and thought about it, and heard other alternative views.
Rick elaborated on one of the earlier questions. He says the board asks the CEO for the story, and then they ask the CFO for the truth. It's a nice way of putting it.
It's a great way of putting it. I'd argue that most companies don't have a CFO or a CFO services nearly early enough. That's one thing that we've had companies doing $20 million of revenue without a real CFO function. So being able to outsource it or bring it from resources like Rick would make a lot of sense early on.
Hey, Chris, it's Rick. It's that painful when they've done the revenue and you have to go in and try to fix their books because they hate you because they're wondering what takes so long versus starting fresh from the beginning. So, and thank you. Are you now my sponsor? I love this guy.
I'm sure there's symbiosis here that we can cultivate. So, Chris, you mentioned how you sort of joke, tongue in cheek, that you're in the business of losing money. But when it comes to that sort of sting of failure, what do you value? Because you hear often how, companies should fail fast or fail forward, or, and that there's this value, intrinsic value to failure. Do you look for that in an entrepreneur that has been through that and had that sting of failure? And how do you relate to that through what you said about how you're in the business of losing money?
Well, I'd say that there are founders that have failed and we've lost all our money that we would invest in again. And there are founders that have failed and we've lost all of our money that we would never come within 10 feet of. And usually that's because the ones that you would back again did all the things that we've been talking about. They were transparent, they were collaborative, they were coachable. And I'll give you an example. We invested in a company. It was going great. It was based on a lot of other industry partners like Facebook's technology. And overnight, Facebook made a decision that changed the layout of how their technology worked, and we were out of business. And because we were out of business, wasn't any fault of the CEO, it wasn't any fault of the board. It was just the industry landscape changed overnight, and our product and service just didn't work well anymore. It wasn't valuable. The value proposition went away. Well, that's a CEO you're probably still going to invest in. The other CEO where, they weren't on top of their finances, they didn't know we were out of money already, and they weren't self-aware enough to know that they didn't know it. That's a CEO that we can't invest in again. So I'm not sure failing fast or failing quickly is the objective. I think the objective is you try to build the business, you're going to have to pivot, you're going to have to change. But if you do it in the right ways, there are periods of time where you have to look at your business plan objectively and not as a child that you've been growing for the last 5 years and say, is this still viable? And if you can look at it and say it's not viable and walk away and make the best out of it, save the most money for your investors, be transparent, do all the right things, that's kind of the way to fail.
sound advice. Thank you very much. Well, Chris, I think that will conclude it for the fireside chat here. If anybody else has any last minute questions, please post them. Otherwise, we will go ahead and thank Chris for coming out and telling us more about TCP Venture Capital, which, by the way, again, according to CB Insights, the most active fund in the state of Maryland. Real quick, though, Chris, what does it take to get to be the most active fund in the state of Maryland?
Pre-pandemic, it's going to a lot of cocktail parties. It's talking to a lot of companies. Post-pandemic or during the pandemic, it's doing a whole lot of Zoom calls with a whole lot of companies. So if you don't mind, Graham, I don't have access to the chat right now because I flipped to the cell phone, but feel free to put my email address in the chat for everybody. You know, glad to help out any way I can with their businesses. If people see good businesses that they'd like to send our way, please feel free to use my email and send them our way. But we want to be a good community citizen and help anybody we can.
And that email, I'm going to put it here for everybody, is ccollege@tcp.vc. One second, ccollege@tcp.vc. So there you go, everybody. Anyone who wants to follow up with Chris, he's welcoming you to. And thank you again, Chris, for being so giving of your time. And I think this is really insightful. I'm really glad we did this. And we hope to do this again with some more, of your peers in venture capital. So thank you very much.
Thank you, Graham, and thanks everybody for participating.
All right. Well, everybody, that concludes another successful 1 Million Cups Westminster meeting. Next week, we are going to have actually a Chicago-based startup called yoursocialmediasherpa.com. So maybe our theme next week will be social media. And we are still waiting for a second presenter to confirm, and we may very well get another investor, another VC to come out and share their experiences as well, just like Chris did today. So thank you all very much for coming, and we'll be here again next week. Take care, everybody.